Hi, this is Brandon Bischoff with Canterbury Investment Management. This is the Canterbury Market Update for the week of February the 24th, 2020. And so starting with the market state, it looks like Monday's outlier day or large move down about 3.3% was enough to trigger what we call a velocity of volatility spike and put the market from a bullish market environment to a transitional market state 6. Now Canterbury defines a velocity of volatility spike as a 7-point move in the Canterbury Volatility Index in one day. And what it is a sort of a warning sign that volatility has increased and it'll temporarily put us in that transitional market state. But if we're looking at the market, when these large outlier days occur, it's important to keep in mind that markets are going to go from a low volatility bull market to a high volatility bear market overnight. It requires a process in order to do that. And so if we're looking at the S&P 500, well, that peaked on February 19th or a couple days ago. And even with Monday's large outlier of, down 3.3%, the market is still 4.75% off of its high or off of its all-time high. And Canterbury defines a normal pullback in the market as about 5%, and a normal bull market correction is about, 10 to 12%. And so, looking at where the market's at now, even with that large outlier day on Monday, the market's still within the realm of normal noise. So, looking at the velocity of volatility spike and kind of the history behind these things and when they have occurred, they typically occur, in bull markets when you have lower volatility, and then you see a spike in volatility. And so, since 1950, looking at the S&P 500, there have been 51 velocity of volatility spikes or velocity of volatility triggers. And of these 51 spikes that moved the market from a bullish market environment to a transitional market environment, 80% or about 40 of those periods went back to a bullish market environment after being transitional temporarily. And so, Monday's move, which actually, if we're looking at the largest velocity of volatility spikes, Monday's move ranks about 9th. It's the 9th largest outlier day that we've seen. So if we're looking at a chart here, we can see the top 20. And of these top 20, outlier days that cause a velocity of volatility spike, all but one actually went back into being a bullish market environment. Now that's not to say that, beyond when they went back into being a bullish market environment, maybe volatility, increased a little bit down the road, but just looking at the next market environment, most of them went back to being bullish. The exception being that trading anomaly we saw back in December of 2018, but even that, quickly recovered. So if we're looking at this, this table shows the date that the velocity of volatility spike happened, the extent of the outlier day. So you can see the largest outlier day was about 7%, 6.5%, 6%, 4%, 5%. The next environment that occurred, which we just went over, and then the maximum drawdown from the previous peak. So we just said that a normal correction in the bull market's about 10%, and you can see that with the exception of the one that went to a bearish market state, all these fall within that range of a normal correction or normal market pullback within a bull market. And then lastly, days to a new market high. Most of these velocity of volatility spikes after they occurred, it took within 3 months to get to a new market high or to reach that previous peak. Canterbury portfolio thermostat and its portfolio efficiency. It has an efficient level of diversification and it has low volatility for being in a bull market. And so if we're looking at the portfolio thermostat currently, it's less than 3% off of its old high. So we're still within our goal of wanting to limit drawdowns to the normal bull market corrections of about 10%. We're less than 3% off of a new high. And so this volatility spike isn't really a reason to panic yet because the market's still within its normal range of noise and it requires a process to go from a bull to a bear market. We really haven't seen a market pullback in quite some time now, and those should be expected during bull market environments. As we sort of navigate the current transitional environment, we'll continue to monitor for any changes in volatility, and the portfolio thermostat, being an adaptive portfolio strategy, will continue to adapt both of its holdings and allocations to navigate the changing market environments. But that brings us to the end of this week's update. Thank you, and I hope you had a great week.